Ever wondered how to navigate the choppy waters of volatile markets? Well, one strategy that traders often employ is the straddle trading strategy. This is a popular approach in options trading that involves buying both a call option and a put option with the same strike price and expiration date. Essentially, you're straddling both sides of the market, preparing for both bullish and bearish scenarios. So how does this strategy work? First off, you need to identify volatile situations. This involves looking for circumstances where a significant price movement in the underlying asset is expected. It could be an upcoming earnings report, a major announcement, or any event that could stir the pot and cause volatility. Once you've identified a potential volatile situation, your next step is choosing a strike price and expiration date that aligns with your volatility expectations. The strike price is typically set at or near the current market price of the asset, and the expiration date should give enough time for the expected price movement to occur. Now, with your strike price and expiration date set, you purchase both a call option and a put option. The call option gives you the right to buy the underlying asset at the strike price within a specified time frame, while the put option gives you the right to sell the underlying asset at the strike price within the same period. Here's where it gets interesting. If the price of the underlying asset rises significantly, your call option becomes profitable. You can then exercise this option and buy the asset at the lower strike price. On the other hand, if the price falls, your put option becomes profitable, allowing you to sell the asset at the higher strike price. But remember, with great power comes great responsibility. Since you're buying both a call and put option, the cost of initiating a straddle position can be higher compared to other strategies. Therefore, risk management is paramount. Consider factors such as the total cost of the options, your potential maximum loss, and the likelihood of significant price movement. And let's not forget about your break-even points. The success of your straddle strategy hinges on the magnitude of the price movement. You calculate your break-even points by adding or subtracting the total cost of the options from the strike price. In summary, the straddle trading strategy can be a powerful tool in volatile market conditions where significant price movement is expected. However, it's not a one-size-fits-all solution. It requires careful analysis, solid risk management, and an understanding of market dynamics. Consider it as part of your trading toolkit, a strategy to deploy when the market conditions are just right.